This video is going to be over wicks. I'm first going to talk about what wicks are on the lower time frame, and then talk about what it looks like for a wick to be respected or for a wick to be disrespected. So let's get straight into it. So let's really slow this down and understand wicks properly. A wick is not just some random shadow on a candle. A wick represents lower time frame aggression and reversal that happened inside that higher time frame candle. When you see a long lower wick, that means at some point during that time period price sold off aggressively on the lower time frame, and then buyers stepped in just as aggressively and pushed price back up before the candle closed. So when you see a wick, you are actually looking at a lower time frame reversal compressed into a single higher time frame candle. Now, how do we actually use that information? The main level I care about with wicks is the 50% level. I measure from the body of the candle to the extreme of the wick. If it is a lower wick, I measure from the body down to the low. If it is an upper wick, I measure from the body up to the high. That midpoint becomes extremely important. Let's say we have a bullish lower wick. That means price moved aggressively lower first, then reversed and closed higher. Now, on the next candle, I want to see price respect the upper half of that wick. In other words, if price trades into that wick but holds above the 50% level and then moves higher, that wick is being respected. That tells me the reaction that created the wick is still valid. In a bearish scenario with an upper wick, if price opens, trades into the lower half of that upper wick, and then continues lower without pushing above the midpoint, that wick is being respected to the downside. Now, what does disrespect look like? If price cannot hold the 50% level of the wick, that is a warning sign. For example, if we have a bullish lower wick and the next candle opens and trades through the 50% level, fails to hold it, and starts pushing lower, that usually means price is going to run the full wick and take out the low. Same thing with an upper wick. If price trades above the 50% level and fails to reject from it, there is a strong chance the full high will be taken. On the lower time frame, this is very clear. You will see price open, move into the wick, form a small reversal structure, and then either respect the midpoint and continue, or fail to hold it and reverse the other way. When you zoom back out to the higher time frame, all of that lower time frame battle just shows up as a simple wick. So the key concept is this. A wick is a lower time frame reversal. The 50% level of the wick is the line in the sand. If price respects the correct half, continuation is likely. If it disrespects it, the entire wick is often taken. So now let's hop into the charts and walk through a clean example where price actually respected the wick. First, on the daily chart, you can see price takes out the previous day's low and then closes back inside the range. That close back inside is important. It tells us that the sell-side liquidity below the low has been taken and rejected. Based on my daily bias model, when I see something like this, I would start looking for price to trade higher. But the question is, higher from where? With a reversal candle that leaves a lower wick like this, I am focused on price respecting the upper half of that wick. That 50% level becomes my line in the sand. I want to see price open, potentially trade down into that upper half of the wick, form a low, and then move higher. Now let's drop down to the hourly time frame to see what that actually looks like in detail. Here on the hourly chart, you can see where the previous day's low was taken and closed back above. That entire rejection is compressed into the daily wick. If we are expecting continuation higher, we want to see price respect the upper half of that daily wick. That means on the hourly chart, we are looking for an open, a low forming within that upper half, and then expansion higher into the highs before the daily candle closes. As price continues to develop, you can see exactly that structure form. We get the open, then a low is established, and then we get expansion higher. If you draw this sequence back onto the daily candle, you can clearly see how the higher time frame wick was respected. The lower time frame action formed the open, the low inside the correct half of the wick, then the high, and eventually the close. So what looked like a simple wick on the daily chart was actually a structured lower time frame sequence of open, low, expansion, and continuation. That is what respecting a wick looks like. Let me show you one more example of price respecting the wick. Here we are on the daily time frame again. You can see price sweeps the previous daily high. That previous high is our buy-side liquidity. After the sweep, we are left with a clear upper wick on the daily candle. Now what am I expecting? Since this is an upper wick, I want price to respect the lower half of that wick. In other words, if the next daily candle opens, I want to see it form a high within the lower half of that wick and then expand lower. I do not want to see price trade above the midpoint of that wick. So let's see what happens. The next daily candle opens. Price trades up into that wick area but stays within the lower half. It forms a high inside that zone, and then we get a change in state of delivery on the 1 hour time frame. After that shift, price expands lower. That is a clean example of respecting the wick. The midpoint held. Price did not violate the equilibrium of the wick. Instead, it respected that level and continued in the anticipated direction. This is how you apply the wick concept in your trading. You identify the sweep, mark the 50% of the wick, and then watch how the next candle behaves around that level. You can adapt this to your own models, whether you trade reversals, continuations, or intraday setups. It is a simple concept, but it adds a lot of clarity to higher time frame bias. Now let me show you one final example where price disrespects the wick equilibrium, so you can see the difference clearly. So moving on to the charts, here we have a sell-side liquidity sweep where the previous day's low gets taken. After that sweep, the normal expectation would be for price to respect the upper half of that lower wick and continue higher. But what happens if that does not occur? Instead of holding above the midpoint of the wick, price starts to disrespect it. That is the first warning sign that the bullish reaction may fail. Now, if we drop down to the 1 minute time frame, you can clearly see that price is not displacing to the upside. Instead, it is rejecting. There is no strong bullish continuation. Rather, we start to see weakness. Then we get a high swept on the lower time frame, and what we are looking for next is bearish confirmation. And we get it. We see a clear change in state of delivery. That confirms that the wick equilibrium was not respected and that price is likely to run the opposite side. After that shift, you can see price expands lower and trades straight into the standard deviation projections of the wick. That is a clean example of wick disrespect leading to continuation in the opposite direction. So overall, that is how you use the wick concept. You identify the sweep, mark the midpoint of the wick, observe whether price respects or disrespects that equilibrium, and then align with the confirmation on the lower time frame. But one important thing, I do not want you trading only based on this concept. This should be aligned with your existing model, your narrative, your higher time frame bias, and your entry confirmations. When combined properly, this concept becomes very powerful. All right, so that wraps up the wick concept. Remember, wicks are not random. They represent lower time frame reversals. The 50% level of the wick is your equilibrium. If price respects that level, you look for continuation. If price disrespects it, you prepare for the full wick to get taken. But do not trade this concept in isolation. Always align it with your higher time frame bias, liquidity framework, and your entry model. That is what makes it powerful. If this helped you, make sure you like the video, subscribe to the channel, and share it with someone who needs to understand wicks properly. If you want to connect with me, join my Telegram and Discord. Links are in the description. And if you want to learn personally from me, check out the mentorship link below. I will see you in the next one.